The March quarter was a good quarter for the SGH Property Income Fund, delivering a return of 3.7%. Now, this contrasted markedly to the AREIT sector, which was in fact down 6.6%. The AREIT sector was influenced in the month of February by the Goodman Group capital raising, and in the month of March, in our view, due to a slight sell-off in real bond yields, which has negative valuation implications in terms of the sector. We also had reporting season during the March quarter, which was quite positive for AREITs. Valuations were essentially stable, a little bit of softening in some of the office names. Occupancy was resilient. We had slight negative earnings revisions for the sector. However, the portfolio proved more resilient, which provides some explanation as to the outperformance as well for the portfolio. Now, post the end of the quarter, I would have to say we've had some major announcements by Trump in terms of tariffs, and also retaliation by the Chinese in terms of those tariffs. And this has seen gyrations through the equity markets. Our portfolio has proved to be a lot more resilient through this sell-off, holding up quite well. And this to us makes sense, and by design. We are focused on traditional REITs, rent collecting REITs with, in many cases, long-term lease contracts at attractive valuations. And what we're actually seeing in the markets is we've seen a rally in bonds, a slight rally, I'd have to say, but more significantly, the prospects of more meaningful interest rate cuts, which may in fact provide earnings tailwinds going forward. So our holdings are holding up very well through these more challenging times. For the SGH Property Income Fund, our focus is on investing in good quality traditional REITs for income, underpinned by rent. The portfolio positioning, as you would expect, has not changed a lot over the quarter. We've been adding to our position in GPT Group. We've added Growthpoint Australia into the portfolio. The catalyst there being the valuation now looks more attractive as the prices come back, but also they've sold down some industrial properties into a fund, which has reduced their gearing as well. So we quite like that move. Against that, we've been reducing our positioning in Vicinity Centres and Scentre Group. We do like those names. They were larger holdings. We've reduced the holdings. Now, as we move post-quarter end, we will be a little bit more cautious in terms of the discretionary end of the retail market, but we're more positive in terms of the non-discretionary end of the retail market. So we've been increasing our exposure there, primarily through Region Group. In terms of the portfolio, it is well positioned, it is very resilient, it is traded on attractive valuation metrics in terms of about a 15% discount to its net tangible asset backing and around a 20% discount to our net asset value using our through the cycle approach. So pulling that all together, we feel quite constructive on the outlook for our portfolio from here. We've seen a bit of a rally in real bond yields, as I mentioned before. We see more meaningful interest rate cuts could manifest, which could provide a earnings tailwind going forward, and the valuation, as I mentioned earlier before, is quite attractive. These are interesting times that we find ourselves in today, post-month end. But having been around the markets now for 30 years, there's always interesting times. And that's why putting together a portfolio that is well constructed is very important. A portfolio that's diversified. We only have one holding that's above 10% and well under our 15% limit. And that contrasts the AREIT sector where we have one stock that's 35% of that sector, for example. What we've been doing over the past year is we've been broadening our portfolio across the names, across the size. We've been going into smaller names where we see good value and very resilient, less economically sensitive securities, such as childcare might be one of them. We've been broadening out in terms of the type of sectors that we've invested in as well. And I just mentioned childcare, that's one that we've been increasing our exposure. So the portfolio is very diversified. We like that. The valuation is attractive, trading below NTA. The portfolio has proved to be very resilient through the tough months of February, March, and now extending to April. It pretty much hasn't missed a beat. As we sit here today, the prospects of interest rate cuts are higher. And if you have resilient cash flow underpinned by leases, and think of assets like it might be a service station, it might be a childcare centre, things like that, the rental income stream is not really going to change, but the cost of the debt is actually going to reduce. So that provides an earnings tailwind, which is positive. Bond yields have rallied a little bit as we sit here today, and that provides a little bit of a valuation buffer as well for the portfolio. So going forward, we expect the portfolio characteristics that we've found in the last few months to be resilient. The income yield is also attracted from the portfolio and a major focus for us, and we expect that to also support the returns going forward.